Welcome to the BF Anderson Technical Report for February the 8th. It's been a wild week. It's been a difficult week. You know, the thing you have to realize about markets is that there are easy markets, and easy markets are generally followed by difficult markets. And then difficult markets are followed by easy markets. So the key is, and there's a book on this called The Battle for Investment Survival. The key to this is to survive the down markets, which means you have to be incrementally defensive, which means you don't make drastic moves, you make incremental moves. So let me bring you up to date on what's going on. First thing I wanted to do is look at 5 indexes. The first is the NASDAQ. This is the NASDAQ index. This is our short-term trend following indicator that I'm looking at. This is the 25-day moving average and the 50-day moving average. Now you can see that the NASDAQ has broken both moving averages, had a dramatic drop followed by another dramatic drop, and continues to be below the lower moving average. So the rule is that when you've got this type of movement down, you should basically shut down any aggressive activity, and you should be getting more defensive. So this is one index. Now let's look at another index. This is the mid caps. This is the S&P 500 mid cap index. Now you can see much more dramatic drop here than the NASDAQ. The NASDAQ, by the way, is holding up the best of all the indexes that I follow. Now we're below both moving averages. This lower moving average is actually starting to turn flat, probably will turn down. So again, the mid-cap index does not look very strong. Here's the New York Composite. Now this is the big stocks. This is all the stocks on the New York Stock Exchange. You can see again, more weakness in the NASDAQ, a breakdown below the lower moving average. The lower moving average has not begun to turn down yet, but again, this is signaling that there has been a real dramatic short-term drop here. Here is the small cap index, same kind of problem here, and you can see it's actually starting to turn down. The small caps are having a tough time. So if the generals, meaning the big stocks, are having a tough time, it's hard to get the troops to follow. Now this is the S&P 500. This is the large caps. Again, like the NASDAQ, this is probably holding up fairly well relative to everything else. So basically in conclusion here, on the short term, it's time to be defensive. It's time to put the defensive team on the field, which means that you just slow down and just don't be aggressive here. Just let's see how this thing works out and see if it starts to stabilize. Now, let's take a look at a long-term report. Now, the market report that's attached to this video, every week we show this particular arrangement of moving averages. We're looking at in this case, we're looking at a monthly chart of the S&P 500. Then we use a 10-month moving average and a 20-month moving average. We're looking for death crosses and we're looking for golden crosses, and we continue to be on a golden cross here, and on a monthly basis the S&P 500 has not even broken the upper moving average. Now, the reason this is important is that one of the smartest analysts that I know out there is a lady by the name of Louise Yamada. Louise is in her 80s. She has her own firm. She used to be with a major firm in the past, and I've followed her for a long time, and she has really back-tested this particular signal. And the reason, and she's very big on monthly charts and thinks that that's the way to go. Now let's look at the top 5 just to see what kind of changes are taking place here in the market. This is AbbVie, biotech. They're actually working on a drug that is using cannabis, and it has to do with nausea. But anyway, the stock has been very strong, is holding above the moving averages, and that's AbbVie. Here is another biotech, Global Blood Therapeutics, using blood to test for cancers and so forth. Again, holding up extremely well here. Netflix, which is kind of turning out to be a very interesting situation here, continues to hold above the moving averages, really looks to be in good shape. Now, what we're trying to say here is that you should not be buying these stocks at this time. They should be at your watch list, and realize that these stocks are holding up better than the overall market. That's why you should be paying attention to them. Now, here's a surprise. We picked up this one just this week. Twitter, which is an internet-related company. It looks like the stock is in an uptrend, holding well above the moving averages. Okay, finally, we have Urban Outfitters, which is a brick-and-mortar retailer. Now, it's not holding up quite as well as the others, but continues to be in an uptrend, as you can see. So if you have any questions, give me a call. But the main message this morning is that the short-term indicators have turned negative. You should become somewhat neutral here. Don't get too defensive, but just kind of be thinking in terms of defense. Thank you very much.